All right, welcome back. Today, we're jumping into a really important chapter from Benjamin Graham's masterpiece, The Intelligent Investor. We're going to get inside the head of what he calls the defensive investor and figure out how they should be thinking about the stock market. This chapter really hits on a huge question that I think a lot of us have. How do you build wealth without constantly stressing out and taking massive risks?
I mean, it's the classic problem, right? You know you have to invest for your future, but man, the thought of the market going up and down like a yo-yo, it can be totally paralyzing. Well, the good news is this chapter lays out a super clear, time-tested game plan just for the cautious investor. So let's dive in.
Okay, first things first, let's get on the same page. Who exactly is this defensive investor? Look, it's not someone who's just scared of investing and hides their money under a mattress. No, not at all. It's someone who's smart about it, who really values their peace of mind. Their number one rule, avoid the big, stupid mistakes. And their goal? It's simply to get good, dependable results without having to be glued to their stock ticker 24/7. Sounds pretty good?
Now, I know what you might be thinking. This sounds kind of backwards, doesn't it? If you're defensive, shouldn't you just stay away from the stock market altogether? Well, according to Graham, that's actually a really common and really expensive mistake to make. Let's break down why. I love how this really shows the two faces of the stock market. If you're just looking at it day to day, yeah, it's a total roller coaster. It seems completely chaotic, all driven by emotion, fear one day, greed the next. But if you just zoom out and look at the bigger picture, the long game, a completely different story emerges. The market transforms into this incredibly powerful engine for growth. And that, right there, is essential if you want to build real wealth. So here's the bottom line, and this is so important. Just letting your money sit in cash or even in super low-yield bonds is pretty much a guaranteed way to lose purchasing power to inflation over time. It's a slow leak in your financial boat. Stocks, even with all their ups and downs, are simply the most effective tool we have to actually grow our wealth faster than inflation. So for the defensive investor, stocks aren't just some nice-to-have option. They're an absolute necessity. Okay, so we've established why a defensive investor needs to be in the stock market. That's the first hurdle. Now for the big one. How do you actually do it? This is where Graham's advice gets really practical and honestly, pretty empowering. First, let's talk about the hard way. The way you always see in movies and on the news. It's this idea that you can be a genius, outsmart the entire market, and pick that one stock that's going to go to the moon. But let's be real. For almost everyone, and especially for a defensive investor, this is a super high-risk, high-effort game that honestly feels a lot more like gambling than investing. And here's the alternative, the defensive way. And it's so beautifully simple and effective. Instead of trying to find that one magic needle in the haystack, you just buy the whole haystack. It's that simple. By owning a huge collection of stocks, say through an index fund that tracks the entire market, you get a piece of the overall economic growth, and you dramatically slash the risk that one single company going bust will sink your portfolio. This right here, this idea is the absolute cornerstone of the whole defensive strategy. It's such a powerful mindset shift. Your safety as an investor doesn't come from being some stock-picking wizard. It actually comes from admitting that you're not one and then building a portfolio that protects you from that fact. I mean, the math is just simple. If one company fails and you own hundreds, it's just a tiny blip. But if you only own a handful of stocks, it could be a total catastrophe. Diversification truly is your best defense. So, here's the tricky part. You could have the perfect strategy, right? A beautifully diversified portfolio. And you can still mess it all up. How? Well, this chapter argues that once you're all set up, the single biggest risk to your own money is you. It's your own behavior. And this is such a critical insight. The moment you start thinking, hey, I know better than the market, that's when the trouble starts. You get overconfident. You start fiddling with your investments, trading in and out, trying to time things perfectly. And that almost always leads to worse returns. It's like having an enemy on the inside, sabotaging your own carefully made plans. And these are the classic traps that overconfidence sets for us. First, trying to beat the market, that's the big one. Then there's trading way too often, which just racks up fees and taxes that eat into your returns. And maybe the most important of all, letting your emotions call the shots. Making decisions based on fear or greed is just a recipe for disaster. A defensive investor's main job is to learn how to shut those urges down.
So if overconfidence and emotion are the bad guys in this story, who are the heroes? Well, it's these two right here, discipline and patience. It takes discipline to just stick with your plan, especially when the market is going crazy, either up or down. And it takes patience to just sit back and let your portfolio do its thing over years and decades. It really boils down to this: your temperament, your character, is way more important than how smart you are.
And this all leads us to the final piece of the puzzle. And, it might be the most important one. To really succeed with this strategy, you have to completely change how you define winning in the first place. Just look at this contrast. It's perfect. Most people think investing is all about maximizing returns, right? Hitting home runs, getting the biggest number possible, bragging to your friends. But that kind of thinking leads you to chase hot trends and take silly risks. The intelligent investor, they have a totally different goal. They're just trying to get a satisfactory result, an outcome that meets their financial goals with the least amount of effort, stress, and drama. It's this huge shift in thinking, from greed to just enough.
So let's wrap this up and boil it down to the key takeaways. Number 1, you have to own stocks to beat inflation over the long haul. Number 2, don't try to be a hero picking stocks. Just own a lot of them through diversification. Number 3, get a handle on your own emotions. They are your biggest enemy in this game. And finally, number 4, change your goal. Don't shoot for the moon. Just aim for good enough, for a satisfactory return, and you'll be far more likely to actually succeed.
And that really just leaves us with this one last question to think about. The path of the defensive investor, it's not about getting rich quick. It's not flashy. It's about the slow, steady, and patient process of building real wealth. It's about creating a financial future that's secure, one that actually lets you sleep at night. So the question is, which path are you on?